Hey traders, it's Josh at Option Sizzle doing a video for Thursday, March 18th. I'm going to talk about FedEx here and I'm going to talk about a calendar spread. The trade that I'm going to walk you through was one that I posted in my elite chat room, and it's one that I goofed up on today, and I want to walk you through exactly where my analysis seemed to be right, just my execution and getting shaken out of it I didn't execute on. So I just want to walk you through and make this a pretty quick video. Yesterday what I was seeing was there was a decent amount of action leaning towards the bullish side on FedEx. We saw that the April 95s were seeing some action, and the same thing on the April 90s. The puts were seeing some action. It looked to be two-sided, and one of the things I wanted to look at um, in FedEx was that I was looking at a pattern here, and one of the patterns I was looking at, and we'll take a little bit of a zoom in here, was a possible head and shoulders. Inverse head and shoulders. I'm not big on patterns, but when I do recognize them, and I often do, I understand of what I'm exactly seeing. I try to put it in a bigger time frame picture, and I also try to shrink it and make it into a short time. So anyways, you can see here what I'm drawing is a head and shoulder, where you got shoulder, head, shoulder, and then on yesterday we saw a big move higher, with today coming back to touch that level of support. I'm going to walk you through exactly some of the things that I didn't look at and I didn't keep an eye out for. So first of all, note that this level right here is a support level. We had some congestion in this level here, and prices have saw buyers come in right underneath the resistance and then broke out, and then we came back to what I always call to retouch. So what I was looking at wasn't at this candle here. I was looking at the overall picture here that FedEx has moved up, forming this inverse head and shoulder. It could be powerful, and it could take out recent highs here about 92.50. Let's go back to the trade page here of yesterday's activity. Looking at that, what I wanted to keep in mind was what exactly was the market pricing in, and what can I expect out of this? What kind of strategy can I use? And that's how and when you want to approach stuff. You want to find out, you want to see what the stock is doing, and then apply that strategy to it. So I'm looking here, and this is not the trade I was looking for. I'm looking for what the at the money straddle was trading for, and we could see it was about $3.50. So at that time they were pricing in about a 3.5% move into on these closing prices. So a 3% move puts prices, they're pricing in about a $3.50 move, so they're pricing in, uh, 93.50 to the upside, and then to the downside, um, back into that support level or that congestion area. So you have to keep in mind on that, and that's when you want to understand if gaps are, a gap lower is meant to be bought, or a gap higher is meant to be bought as well. So looking at that, one of the things I wanted to say was, going out for these 95s wasn't going to give me much action. It wasn't going to give me much money. So what I wanted to do was to go at the money here. I wanted to sell this 90 because I figured even if it did go into the money, um, at the time, you know, the pretty much 20 cents away from being 90, you would say that you have about, it's 70 cents of extrinsic value, I would say. Um, so you could say 50 to 70 of extrinsic value. That if this actually did go in the money and I was right on my direction, this would just become in the money here, and then the time value on these would explode, and the implied volatility would tick up higher. So instead of playing the 95, where that's a pretty much a almost 6% move, I was just looking for a little bit of a safer play with going in the money and not trying to hit a home run. So what I did was I bought the April, and I'm buying a calendar spread. So what I'm doing here, and I've talked about this in previous videos, is I'm selling the March and I'm buying the April 90. And you can see here, we pretty much did it for $1.30. And coming into today, we saw prices. Let's take a look at the chart here. we saw prices gap lower here. We had a little bit of a run up higher, and then on the earnings announcement pre-market, prices fell here, and then hit a low here, and then started to reverse. I want to walk you through exactly what was going on. So in the morning, even with that gap lower, my trade was made money because of the implied volatility that got taken out of here, the premium that got sucked out of it as well, because this wasn't the prices at that time that opened up were opened here about 87 and then dropped down to about 87.40 or 87.80 and then dropped down to 87 and then ran up higher here. So in the morning, I had this trade and I made a little bit of money on it. I left a lot of money on the table. I could have, if I closed it at the right on this run up here, I would have made 50% on my investment. So the things that went wrong on this, and I'm going to walk you through, is one of the things you want to look at and keep an eye out for is the first 15 minutes. Now in pre-market you can see that we had a gap lower, and the trade could potentially go against me. At times you might have a trade that you have on that's gapped the opposite way of what you were looking to do, and it's gone through your stop. You have two choices. You could panic out of it, or you could just kind of understand and see where prices settle at the open. Since there's just so much, there's a ton of orders looking to be filled, especially after an earnings. The market makers have to match each order. There's going to be a lot of price movement that might shake you out. So that's why you'd want to wait 15 minutes. So on a gap lower here, you can see here that the candle, even though it's red and there's big volume, and there's big volume because there's individuals buying, there's individuals selling, and there's large orders that need to be matched. The emotion behind the candle is it's a reversal. We had a gap lower and buyers bought it up here. In the first 15 minutes on this close, buyers potentially almost brought prices all the way back. So they brought about 75% back up into this candle, showing you that there's buyers. At that time, buyers are dominating the order flow, not sellers. And then you can see here the next 15 minutes that buyers stepped in and took out of that range. And if you're playing on gaps here, this is where you would play the opposite of the gap. You would play this into the run here and look to fill it here, which you did, and then continue to run higher into 92. Where I made my mistake, I exited here in the first 10 minutes. I didn't wait for the first 15 minutes to settle. I exited pretty much right. I didn't take a look at the chart, actually. I didn't take a look at the 15. I was looking at a different chart, and that's where I made my mistake at here. I made my mistake because I didn't follow that exact rule, and if I did, back here, I would have been in a trade. I would have not left money on the table. So those things you have to keep in consideration and understand when you're playing earnings or what happens if there's a gap. There's a few different lessons I put in here. One was of how to do the calendar spread. The other one is wait on a gap higher or lower. Wait until the first 15 minutes to see where prices settle. Then make your decision. Don't make it in the first 15 minutes because you will get shaken out of trades just like I just did here. So if you have any questions on the calendar spread or the thinking behind it, or the first 15 minutes, feel free to ask me. I always try to get back to everyone, and I hope this video was helpful, trying to understand of looking at earnings and looking at order flow, and then also the after the fact of a trade not working the way you planned. It still worked, I just didn't give it enough time.